Credit cards, whether they're made out of a flimsy plastic or a solid shiny metal, either way they are some of the best financial tools on the planet. That is, if they fall into the right hands. Because if they fall into the wrong hands and are used improperly, then they can be the doorway to a spiraling death trap. And nobody wants that. So since credit cards and smart financial habits overall are usually not taught in schools, this video is dedicated to exposing the top mistakes beginners tend to make when using credit cards. That way you'll be able to be empowered to avoid those mistakes and have success and stay in control of your financial future. And some of the benefits of doing so include qualifying for the best rates on a big purchase like a house or a car, getting some awesome travel points and rewards to pay for your next vacation, or simply some more cash back in your pocket to pay for your expenses or invest into the markets. And with that said, let's kick things off with mistake number 1, which is using credit cards the wrong way. What I'm referring to here is that credit cards are not free money, so you'll want to treat your credit card like a debit card. That is, what you spend, you pay back. This is my debit card and this is my credit card, and I treat them as if they were the same product. So with a debit card over here, every time I swipe it, the funds are withdrawn from my checking account automatically. In other words, I need to have money in my checking account in order to be able to use this to buy stuff. With a credit card, however, that's not really the case. I could have no money in my checking account and still use this for my purchases for about a 30-day period. Then I get a big bill with all my transactions added up together, and then I gotta pay that full bill off. So at that point, I better have money in my checking account. However, even still, I treat them exactly the same. So if I don't have the money in my bank account, I'm not going to swipe my debit card and I'm not going to swipe my credit card. We'll also discuss a little bit more about how credit cards work and a future mistake a little bit later in this video. On to mistake number 2, and that is applying for the wrong credit cards. Now the following are general recommendations, not hard rules. So overall, if you're a beginner to credit, that is within your first year of building, you might want to look at some student credit cards, especially if you're still enrolled in university, because that's your one opportunity to be able to get those, or some secured credit cards where you put down a deposit, or some no annual fee cards if you already have a little bit of history built up. You might even be able to qualify for some regular unsecured credit cards as your first card, especially if you're applying with a bank where you already have a banking relationship. Sometimes that can work in your favor. But if you're just starting out with no history at all, generally student and or secured cards tend to be much easier to get. Then if you're rebuilding credit, secured cards tend to be a good option. And then once you hit the intermediate stage of having 1 to 2 years of history, then you can start looking into some more sophisticated rewards cards, some of which may have annual fees. And if you're more advanced, having multiple years of credit history, then of course you can play the rewards game without any problem. But it also goes well beyond just the stage of credit building that you happen to be in. Here's some questions that you might want to ask yourself along your journey. For instance, are you trying to build your score? Do you prefer cash back or travel rewards? If you want to travel, what kind of travel? Are you willing to pay an annual fee? Are you willing to manage multiple cards? Do the card benefits fit in with your lifestyle? Do you prefer simple redemptions or complex ones involving research and strategy for bigger value? Ultimately, what it comes down to is getting the cards that help you achieve your goals. And by extension, that also means you should avoid cards just because they're popular. For instance, the Amex Gold card is a really popular card, but if you like cashback rewards, this is one of the worst cards to get of all time, unless you pair it with the Schwab Platinum card or an American Express business checking account. Otherwise, it's really bad for cashback. That's why I always encourage people to really ask themselves, what do they want? What do they value? What are they trying to achieve? And then once you answer those types of questions, then find the right card products that fit in with your goals to help you achieve them. Mistake number 3, not understanding how credit cards work. And here are the steps. First of all, your billing cycle begins. That is your open date. And number 2, you make purchases on your card for about a 30-day period. Step 3, your billing cycle ends. In other words, your close date occurs. Then in step 4, you'll get a statement with all the purchases you made added up together with the amount that you owe. In step 5, you'll notice that statement has a due date. And finally, in step 6, you pay your full statement balance on any day you like up to the due date, which is the last day to avoid interest and get an on-time payment. Essentially, you can view credit cards like a very short-term loan. As you make your purchases, you're using the bank's money, then the bank sends you a bill for all the stuff that you bought, then you pay off your bill. And you do that on or before the due date with your money from your checking account. Also, you might see this thing called a minimum payment on your bill. That's all you have to pay for an on-time payment to be recorded to your account, but you'll be charged interest on everything you did not pay off. So that's why you want to pay in full. Mistake number 4, not understanding your credit card statement, that is your bill. There are a ton of different things on that bill that you want to be aware of, and I actually did a full video running through one of my statements or bills and talking about each individual part, defining it and explaining what it means. So definitely go watch that video to inform yourself. That way you'll understand what's going on with all those crazy numbers. Mistake number 5, carrying a balance from month to month. And this is different from having a balance on your card, which is totally normal because remember, you get a bill once a month, therefore up until you get your bill, you have a balance. But carrying a balance occurs when you pay less than the full statement balance. Here's an example. Let's say you've been using your credit card for the past 30 days and you receive your statement, and that statement balance is $1,000. However, you only pay $700, which means that the remaining $300 is the amount that's carried over to the next month. And that's where that debt snowball starts to grow and grow and grow. Every time you don't pay your full bill, whatever's left over, which is borrowed money, gets carried over from one month to the next, which means that balance can keep growing and growing. Plus interest charges also kick in every single month as well, which means that the debt accumulation starts to really accelerate, and that's where people kind of get buried alive with debt. That's why you want to build smart financial habits now and stay in control of your money so that way it does not control you. And if you do fall into a difficult financial situation where you have to carry a balance, consider getting a card with a 0% APR on balance transfers and or new purchases. Also, if you don't want to do that, you can also call your existing bank with your existing card and see if they're able to lower your current APR rate. That way you'll be paying less interest. Those rates may be negotiable. Mistake number 6, applying for credit cards too frequently. Here's why this is important. Each new application that you submit results in a hard inquiry. If you then get approved for a new credit card, you'll have a new account. And both inquiries and new accounts temporarily lower your credit score. And when you're new to building credit, these score drops can be quite big. So while you're in the early phases of building credit, the focus should be on increasing your score so you can qualify for better cards or products later. There are tons and tons of YouTube channels and blogs out there showing people applying for credit cards like crazy, getting huge bonuses and traveling to exotic places of the world. But that is all later stages in the game. I apply for quite a few cards myself, and that's because I have a very strong foundation of credit to where when I apply for a card, a new inquiry maybe drops my score by 3, 4, 5 points at the most. And also having a high credit score, if I drop from a 785 down to a 780, that doesn't really have any real world implication to me, especially since I'll be able to rebound quite quickly, usually within 1 to 2 or 3 months. However, if you're a beginner, then one inquiry might drop your score by 5, 10, 15, 20 points. It can totally vary. And if your score is kind of low to begin with because you haven't really built up a foundation yet, going from, for example, a 630 down to a 605 could have a pretty big implication. And that's because typically the lower your score goes, the higher interest rates you'll have to pay and the more difficult time you'll have getting approved for additional cards. And while there isn't a set rule for how many cards to get in your first year or how often to apply necessarily, in general, for most people, getting 1 or 2 cards in that first year and building smart financial habits, making on-time payments, staying in control of your spend, etc. is the way to go. Mistake number 7, not knowing when to pay your bill and paying interest. To illustrate this, here's a screenshot from one of my credit card bills from the Chase Freedom Flex card. Putting this in the simplest terms possible, you'll want to pay the full new balance, that is your statement balance, on or before the due date to avoid interest and late fees. So going back to when I received this statement, I made $77 worth of purchases during that previous billing cycle that appeared on my bill. And as long as I pay that full $77 balance off on or before June 1st, then I would avoid all interest, avoid late fees, and I would be good to go. And that's it. It's really that simple. And in case any of you would like a deeper dive into that explanation, I did a separate video dedicated to that topic of when to pay your credit card bill. I recommend recommend you go watch that video if you like as well. I'll also link it down below in the description to this video. Mistake number 8, using a lot of your credit limit or maxing it out. This is all related to a concept known as credit utilization, which is a major factor of your credit score. And if you turn your attention to the bottom right corner of the screen, you'll see the formula for credit utilization. That is your current balance divided by your credit limit. Stated differently, credit utilization is literally how much of your credit limit you're using, and that's both on individual cards and across all of your cards. In general, a lower utilization leads to a better score, and also utilization gets reported one time per month, usually on your statement close date with most banks. Now, if you're in the beginning stages of building credit, you might be receiving some small credit limits on your cards. So how do you report a lower utilization to help your score out while still being responsible? To report a lower utilization, you'll want to follow these steps. First, identify your statement close date. Step 2, make an early payment, that is payment number 1, several days before that statement close date to bring your current balance down to an ideal range. Under 30% of your credit limit is good, and under 10% of your credit limit is best. Step 3, let your billing cycle close and get your statement. And finally, step 4, pay off the remaining statement balance, that is payment number 2, on or before the due date. All you're doing here is taking your current balance and lowering it, allowing that smaller balance to get reported, and then paying off the rest once you get your bill. That way you report a lower utilization, you get an on-time payment, and you avoid interest, fees, and other penalties, all of which help you build a great score. Mistake number 9, missing a sign-up bonus. A sign-up bonus where you spend a certain amount of money in a certain amount of time to get a big amount of points or cash back is the #1 way to get big value fast. That could be cash to cover your expenses or invest into the markets, or points to pay for your upcoming vacation. And if that bonus is worth 200, 400, 800 or more, then you definitely don't want to miss it, because earning that amount of value through your regular spend on your credit cards would probably take you a lot longer. And also with point number 3, always spend more than the requirement. This leaves room for things like returns, miscounting, etc. I say that because if you apply for a card with a $1,500 spend requirement in a 3-month period, for example, and then you spend just the $1,500 and then do some returns later, and then ultimately you only ended up spending a total of, say, $1,100, then the bank does have the right to take your bonus back because you didn't meet the requirement. So using that example, I personally would probably spend $1,800 or more, again, with my regular expenses before switching to a different card or anything like that. That way I account for things like the returns, and also annual fees or other fees that might get charged do not count toward a spend requirement. Remember that. And mistake number 10, spending more than you normally spend. The amount you spend per month on credit cards should be the same as if you were using a debit card or paying cash. And that also holds true for what we just talked about with those sign-up bonuses. If you cannot meet a spend requirement with your regular spend, then that bonus offer is not right for you. Above all things related to credit cards comes your financial responsibility. And credit cards should help you be financially responsible with getting your statements, keeping track of your expenses, knowing where your money's going, using your rewards the right way to help benefit you, etc. Focus on increasing your income, building wealth, and creating freedom in your life so that way you'll be able to live the life that you truly want, and credit cards can be a tool to help you along that journey. And with all that said, if you enjoyed today's video and believe it could benefit other people, then please help me get it in front of them by liking this video, subscribing to the channel, and turning on those notifications. That way you never miss an awesome upload. Also check out the links down below in the description area to earn some more cash back when you shop online through Rakuten, to get $25 when you open a new SOFI checking and savings account and deposit just $10 or more, and to view my all-new site with some great credit card offers that I've organized into different categories to help you find the cards that you like best. I thank you all for watching today's video. I hope it brought you some great value. I look forward to seeing you in my future videos, and while you're waiting on my next upload, always remember that you are great. Now go out there and win the financial game.